Hey everybody, Smart Silver Stacker here. Hope you're doing well. Thanks for tuning into another live stream. There's a huge risk that in about 6 more weeks, we could see a resurgence of the banking crisis of March 2023. A crisis which was papered over. The reason that this risk is manifesting itself is because a key facility that the Federal Reserve has been using to bail out the banks and to make these insolvent banks solvent is now going away. So we're going to talk about why this is a huge problem. Also, why inflation is likely to be ticking up significantly despite the mainstream narrative that you may be hearing. So needless to say, within the next 6 weeks, I am going to be looking for opportunities to add more gold and silver to my stack. If you recall what happened during the 2023 financial crisis, when the banks started to fail, the premiums on physical silver and gold just began to absolutely soar. So I'm going to buy some more gold and silver from SD Bullion. If you'd like to check them out right now, new customers can get gold or silver at spot by visiting sdbullion.com/new. Now, this is the press release from the Federal Reserve from January 24th. Federal Reserve Board announces the Bank Term Funding Program, BTFP, will cease making new loans as scheduled on March 11th. So this is the facility that the Federal Reserve implemented to provide emergency loans to insolvent banks as depositors were pulling their deposits out, and they wanted to avoid selling treasuries at fire sale prices and accruing huge losses. That was actually the scenario that kicked off the banking crisis. That's what caused investors and depositors to lose confidence in Silicon Valley Bank and First Republic Bank. And so this is one of the programs that they created. Federal Reserve Board on Wednesday announced the Bank Term Funding Program will cease to make new loans as scheduled on March 11th. Program will continue to make loans until that time and is available as an additional source of liquidity for eligible institutions. After March 11th, that's where we get the 6 weeks from, banks and other depository institutions will continue to have ready access to the discount window to meet liquidity needs. Now, this is a chart of the Bank Term Funding Program, which we just got an update on January 25th, so yesterday. And surprise, surprise, this facility, the utilization of this facility by these insolvent regional banks has hit once again a new all-time high, $167.7 billion. Now, they're going to continue issuing these loans until March 11th, as stated. But then what's supposed to happen? Now, the Fed mentioned in that press release that their discount window, which is a place where banks can put up treasuries, collateral, they can get overnight liquidity. Why haven't they been using the discount window since March? Why were they using this Bank Term Funding Program? Well, here's an article from the American Institution for Economic Research, the American Institute for Economic Research, and they tell you what the biggest significant difference here between the Bank Term Funding Program and the Fed's discount window is. I'm just going to read this to you here. The BTFP actually charges a higher rate than the discount windows, so it's more expensive for the banks to borrow money through the BTFP. Yet, the BTFP differs from the discount window in another important aspect. While the BTFP requires banks to offer collateral, it values the collateral at par rather than a mark-to-market basis. If the par value is greater than the mark-to-market value, the Fed may take a loss when a borrowing bank fails, and that's probably exactly what is going to come in March, is we're going to start seeing the Fed taking a loss, aka a bailout of these banks. So to break this down, when these banks put up the treasuries, their treasuries for collateral through the discount window, the Fed values them at their actual market rate, like what they would get if they were to go sell that treasury into the market. Many of the treasuries that these banks are sitting on have a low yield. They were purchased when interest rates were close to zero. And as a result, because treasury yields have risen, they are no longer worth their par value or face value. Their market value has dropped. So the reason these banks are using the BTFP still is because they still have massive unrealized losses from their treasuries. And the only way the Fed really can resolve this is to permanently take those treasuries onto their balance sheet and allow these loans to be extended, or alternatively, they can get into the debt market at large and they can buy up treasuries from the Treasury, from other institutions to drive down yields, which will then lead these treasuries that the banks are holding to no longer have these unrealized losses. And now I believe that's probably what we're going to see. The actual purchase of treasuries by the Federal Reserve to bring down interest rates. Now, if you want to look at some evidence that we may be very close to that and that the Fed is getting in gear for some kind of a bailout for this banking crisis, which may be headed here in March, this is a chart of the Fed balance sheet. It's kind of zoomed in. I mean, if we take the zoomed out view, you can see it's got the QE from the pandemic. And if we zoom it out further, we can see the great financial crisis and all that stuff over here. But I want to zoom it in just to this last bit here because, the Fed has been engaged in quantitative tightening. They've been engaged in it for a while. This latest hump here, this is what happened last March when the Fed had to get in and start actually intervening to bail the banks out again, which is exactly what I believe we're going to see in 2024. The banking crisis that kicked off in 2023, I mean, the by amount of deposits was greater than the crisis of 2008. And yet none of the underlying problems really have been resolved. That's why the BTFP continues to hit record highs every week, and it's been moving up rapidly since last November. Now, the Fed balance sheet with their program of quantitative tightening, you can notice that it's actually started to tick up from the most recent data. If we go to January 17th, the Fed balance sheet was sitting at $7.673 trillion. Now, more recent data, January 24th, $7.67 trillion. So they actually expanded their balance sheet slightly over the past week. And we covered this note from JP Morgan strategist in a previous live stream, but I want to revisit it. This is an article here from longportapp.com, but it's referencing a note. It's hard to find information of this regarding this note from Jay Barry. It doesn't seem like it's really widely available, but the title of this is JP Morgan Chase provides a timeline for the Federal Reserve's QT reduction, discussion in January, announcement in March, implementation in April. And so that is the timeline for the end of QT, the end of asset sales from the Federal Reserve's balance sheet that this JP Morgan strategist is lining up. He's saying they're going to propose a timetable in the FOMC meeting in late January. Then they're going to convey it through the minutes of the meeting to be released mid-February and officially start the balance sheet reduction in April. And then that means slowing the pace of the asset sales. And then by November, they expect QT to be entirely over. Now, from what I'm looking at here on the Fed balance sheet, I mean, it looks like maybe they're already done. And it just depends on how bad things are getting in the financial system. I mean, we're hearing a very rosy picture painted in the mainstream media, which I kind of want to just go ahead and talk about some of the data which was released in this kind of narrative, because none of this is painting the picture of what's actually going on behind the scenes. I mean, we've got a commercial real estate crisis brewing. We've got insolvent regional banks. You've got inflation, which still remains very elevated. And again, we're going to talk about why that's going to be going a lot higher in the very near future here in just a moment. But everything you're hearing right now from the mainstream, from Janet Yellen, these people they float out, from CNBC, from all the mainstream stuff, the most recent data is being painted a very good picture for the U.S. economy. Bidenomics, it's making us all prosperous, according to the mainstream here. The core personnel consumption expenditure price index for December, an important gauge for the Federal Reserve, increased 0.2% on the month and was up 2.9% on a yearly basis. If you include volatile food and energy, headline PCE inflation also rose 0.2% for 2.6% year over year. Now, at the same time, we got this data regarding consumer spending up 0.7%. This is being touted as a sign of economic strength. I think it's just a sign that, the real inflation is higher than what's being reported here. That's why people are spending more money. That's why they're racking up record amounts of credit card debt. It's because everything has gotten so much more expensive. And even if we're only seeing the PCE expand 2.6% annually, you have to remember this is still above 2%. This is still cumulative, it's 2.6% on top of an already significantly expanded inflation. Personal income growth edged lower to 0.3%. So you got income growth down or increasing at 0.3%, spending increasing at 0.7%. So wages not keeping up with inflation here. Now, I want to talk about why, despite the fact that you may be hearing about how inflation is edging lower and we've got this nice disinflation in effect, it's probably about to change. This is the chart for crude oil. You can see now, January 26, year over year, or rather a year to date, crude oil up 11.15% at $78 a barrel. This number, now I've been calling for this for a while, pretty much ever since the hostilities kicked off on October 7th. So far, I have not been correct, although it looks like the trend for oil is beginning to move much higher, and I expect that this is to continue because look at this most recent development in the Red Sea. Oil tanker hit by missile after transiting Red Sea. Houthis claim responsibility. The Marlin Luanda, a petroleum products tanker vessel operated by Trafigura, was struck by the missile in the Gulf of Aden. Now, from what I've read, this caused some pretty catastrophic damage, a fire on board. Many oil tankers are going to be very hesitant to transit the Red Sea, to transit this area. This is going to disrupt supply chains, despite the fact that the Houthis have been struck multiple times, many times now, by coalition airstrikes. It doesn't seem to be deterring their ability to interrupt supply chains here, with now an oil tanker being hit by, from what I've read, multiple cruise missiles. Also, the Houthis have begun targeting directly U.S. naval vessels. So far as I can tell, no direct hits. Of course, we probably wouldn't know about it right away if that did happen. But so far, U.S. anti-ship or anti-missile defense systems seemingly protecting the military vessels. However, it seems like it's only a matter of time before something slips through. Unfortunately, this is the case. Hopefully, cooler heads will prevail and we will not witness escalations, but I wouldn't bet on it at this point, because this scenario is showing absolutely no signs of cooling off anytime soon. This is going to lead to higher inflation for multiple reasons. One, supply chains are disrupted. Now, supply chains for oil, the world's most important commodity, also all these container ships are having to have longer transit times, incurring more costs, incurring higher insurance costs. Not to mention, where's all this money going to come from that's paying for all these munitions? You know, it's hundreds of millions of dollars, billions of dollars of munitions being expended here. It's all going to have to be borrowed. It's all ultimately going to have to be monetized and go onto that Fed balance sheet. So inflation isn't done yet. Despite the fact that we are witnessing a global economic slowdown, which should bring prices down, further supply chain disruptions and money printing, I think, are going to offset that by a large margin. You've got Janet Yellen out here telling us how strong the economy is. U.S. GDP up 3.3%. What do you think this is from? This isn't from economic growth, right? This is from massive deficit spending. This is from massive and growing warfare, huge amounts of borrowing. The most recent quarter, according to the Treasury's most recent report, first quarter of fiscal year 2024, deficit over $500 billion. No wonder we are seeing economic growth. I would hope that you would, but the problem is you're seeing the debt grow faster than the economy. That means this whole thing is entirely unsustainable. And the thing about unsustainable things is that they will not be sustained. Yellen also remarked here on inflation numbers, which have significantly improved since the COVID era. Well, if Janet Yellen's telling you inflation's done, then that means it's probably heading a lot higher. She is a pretty reliable contrarian indicator, and economic growth is basically guaranteed when you're spending at this pace. The problem is you can't do this indefinitely without monetizing all of the debt, because ultimately you run out of buyers for all this debt. Interest rates spike. Well, you know what happens to the banks then when the interest rates on treasuries spike up. They have massive unrealized losses. You get the picture. The Fed's going to have to print. This number right here is going to keep getting a lot bigger. The U.S. national debt. Now we're at $34.13 trillion, folks. $35 trillion very soon. Expect this number to explode. And to avoid a crisis, the Fed's going to have to intervene because the debt is unsustainable now. We have a debt-addicted system. Everybody's leveraged up to the hills. The government, the banks, the businesses, the individuals. Nobody can withstand these higher interest rates. They're going to have to do something. They're either going to have to buy the treasuries from the banks, or they're just going to have to buy all the treasuries, period. I don't know exactly what form this will take. Expect lots of smoke and mirrors when it comes out. They will do everything to deny that it is a bailout. That's exactly what happened last March. And I think just like last March, when this crisis really manifests itself and people realize how unstable things still are and how the crisis from last year really hasn't gone away, the premiums on gold and silver are likely to explode even higher than what we witnessed in March. And what we witnessed in March was pretty extreme. Look, I know sentiment for precious metals right now is kind of in the toilet, and I'm not telling anybody what to do. I'm just telling you what I do. I'm just telling you what I think. But the time to buy is before these crises break out. There were a lot of people who were upset in the previous financial crisis that they had to wait, a month to get their metal. They had to pay sky-high premiums to get their metal. Well, that's what happens to physical precious metals when investors begin to realize that the economy is on the verge of collapse. And we're going to get to a point where the bailouts, the money printing has to be so gargantuan that the inflationary consequences are impossible to ignore. And we could very well see that kick off as early as 6 weeks from now. No guarantees, of course. I don't have a crystal ball. None of this is financial advice, just telling you my thoughts. So let me know what you think in the comments down below. Thanks for watching, everybody. Stay safe and happy stacking, and I will catch you next time. Smart Silver Stacker